All right, now we'll discuss the debt deduction creation rule. And it's important that you are aware of this new rule because it could catch fairly innocent business transactions, which your group might have been undertaking for ages. So the debt deduction creation rule is contained in the same bill as the thin capitalization changes, but it's deferred. The start date is deferred to 1 July 2024. It's a soft start date. So the rules will apply to all existing loans. So that means you might potentially need to look at the historical use of funds from those loans. So what's the purpose? The purpose of the debt deduction creation rule is to deny debt deductions, interest deductions on related party loans, which are used for two specific types of transactions. One is to acquire a CGT asset or an obligation from an associate. So let's call this a type 1 rule. Secondly, the loan was used to fund a distribution or payment to an associate, and this is called a type 2 rule. Now, you might immediately think that the term payment is very wide and could cover anything. Fortunately, with recent changes, it is only limited to a certain list of payments, which I'll go through shortly. It does not apply to funds loans used to incorporate a new subsidiary in Australia or overseas, to provide loans, new loans to an associate, or to acquire new tangible depreciating assets where certain conditions are satisfied. So it has to be new. Now, remember the type 2 rule? I spoke about loans used to make a payment to an associate. Fortunately, with recent changes, it's limited to these type of payments. It's for payment of dividends or non-share distributions, for trust or partnership distributions, to return capital, payments to cancel or redeem membership interests, royalty or similar payments. So keep an eye out for this because royalty payments are quite common for multinational groups. A repayment of a loan which itself would trigger the type 2 rule, and anything else prescribed by the regulation. So something we need to keep an eye out for. So let's look at some examples. And when I read out these examples, I guess think in your mind whether or not you think the debt deduction creation rule will apply, and I'll give you the answer. So in the first example, A Co transfers a building to B Co, and B Co is a sister company, so that's an associate, and the consideration is by way of an interest-bearing loan between the two companies. So in this case, the debt deduction creation rule will be triggered because there is an acquisition of a CGT asset from an associate, and the loan is from a related party as well. In the second example, A Co borrows funds from the parent company to acquire stock, trading stock from an associate manufacturing entity. In this case, it will be triggered as well because trading stock is a CGT asset and it is being acquired from an associate as well. And also be aware of this trap. Sometimes you might have payables to associate for purchase of stock, and you leave it sitting in your trade creditor account. And that trade creditor balance sits there for a long time. The risk with this is that if this trade creditor is with a non-resident, the tax authority could potentially deem that trade creditor to be a financial accommodation or a loan. So if it's a loan, then it's open to deem, the tax authority is open to deem interest to be paid on that deemed loan. And why would they do that? One, they can deny you the deduction for that interest under the debt deduction creation rule, and then levy withholding tax on that interest. So just be aware of that trap. Question 3, example 3, same as 1, except A Co buys business assets, and the business assets are customer list, brand names, and depreciating assets from the associate entity. So in this case, the debt deduction creation rule is triggered as well because the customer list, brand names, and depreciating assets are CGT assets, and these depreciating assets are not new depreciating assets. It has been used by the associated entity, so be aware of that. Example 4, a company incurs charges for management fees, royalty fees, and interest costs. The charges have been capitalized into intercompany loan accounts, and interests are then charged on the intercompany loan accounts. So in this case, that the rule could partially apply to the extent that the loan relates to royalty fees. So in this case, just be aware of that. I would put loans accruals associated with royalties in a separate GL account and make sure that they are paid off as early as possible.